Good evening and thank you for coming. We're going to talk about one of the most important elements of your trust agreement, and that is what to put in the trust and what not to put in the trust. And when you put it in, what does that mean? And when you don't put it in, what does that mean also? Now, our goal tonight isn't to get all of you ready to take the state bar this winter. Our goal is to give you some ideas and some thoughts and some direction and guidance as to how you should set these things up and how you should organize this. Now, one of the things that we offer is to have you submit your statements, your bank statements, your registration items, and have us review them to verify that they are in the name of the trust correctly. Now, some of you have taken advantage of that and done that. Some of you have chosen not to do that. I would encourage you who have not taken the time to submit your paperwork to us and have us check it, to have us do that. That's very important to not only do it, but make sure that it's checked and done correctly. Now, two things I want to clarify. When we say something should be in the name of a trust, we are not saying that it's listed in the trust. Listing an asset in the trust means absolutely nothing. And I know that many of you have had attorneys that have done work for you before you came to us, and in that trust that you had prepared, there was a list of all of the assets. And usually the first thing you said to us is, that list is outdated. Well, it became outdated almost as quickly as the list was made. So putting the assets on a list and attaching it to the trust not only doesn't mean anything, it's a little bit misleading, because you get the impression that the assets have been placed in the trust. That's not how you put them in the trust. The way you put assets in the trust is you go down to the bank and have the signature card changed, and you go down to the county recorder's office and change the deed. Those items that show ownership must reflect the name of the trust. So the trust doesn't refer to the asset refers to the trust. Now, some of you have received an asset detail report. You've submitted a list of your assets, and we've looked at them all and verified that they're in the name of the trust, and then we've made a list. Why do we make the list? We make the list for two reasons. One, it's kind of a checkoff. So we look at the assets that you have, and we verify that they're all registered in the name of the trust the way they're supposed to be. And we use it kind of as a checklist, okay? The second reason why we do it is because when you pass away and your successor trustee, often it's a son or a daughter or a niece or a nephew, often they will come in and they will say to us, so what did they have? If we prepared a list for you, we open the file and say, this is what they have and this is where it is. If we haven't prepared a list for you because you haven't given us the information, we say, we don't know. We hope it's in the trust. We hope it's registered correctly. We hope that the accounts have been all set up correctly, but we honestly don't know, because we're creating a trust that is basically a bucket. But how you get the things in the bucket is a different transaction. Now, when you put things in the name of the trust, there's three things that you want to have on that title of the registration. The number one thing is the trustees, because all trusts have trustees, and the trustees are the people who are managing the day-to-day affairs in the trust. So when you register an account at a financial institution, they will ask you, who are the trustees? So that's the first thing. Second thing they want to know is, what is the name of the trust? Now, if your last name happens to be Smith, your trust would be the Smith Trust. So now the question is, how do we distinguish between my Smith Trust and somebody else's Smith Trust? And that's the third thing that you put on the registration item, and that is the date. The trustee, name of the trust, and then the date. Now, when you make a change to your trust, that's one of the reasons why we don't start all over. We do an amendment or a restatement. Both of those are forms of amendments, but what does not change is the trustees, the name of the trust, and the date. That stays the same. So then you don't have to re-register all of your assets in the name of the trust again. Okay? Now, you'll see some abbreviations. They're a little bit confusing, but if you have a list of them, you can see that a trustee is sometimes TTEE. Banks like to consolidate and summarize these things. And you'll see terms like trust is TR. You'll see dated DDT. And then you'll see under agreement, U/A. And the last one that's most common is UTD, under trust dated. So you have the name of the trust, and then you'll have UTD. Or sometimes they'll have your name, and then TEE, trustee, and then UTD, and then the date of the document. So if you see abbreviations on that, don't be concerned about it. That's not a problem. It's just the bank consolidating and trying to get the information on there. Now, the quickest way to know whether an asset is inside or outside of the trust is look at the statements that you have that come on a monthly basis, or the registration vehicle, like a deed or something like that. Now, let's get very specific and talk about exactly how we put which assets where and how they're registered. Don, do you want to pick it up from here?
All right, JM and I are going to talk a little bit about the assets that need to be put into your trust. I'm going to deal with the first three, which are cash accounts, investments, and United States savings bonds. So let's start with cash accounts. When I'm talking about cash accounts, I'm talking about accounts that are held by banks, credit unions. Sometimes there'll be accounts in a brokerage firm, and sometimes even online accounts. Online accounts have become much more popular than they used to be. You need to be very careful because there are some financial institutions online that won't accept registrations in revocable living trusts. And so before you shift money over there, make sure that they're one of the ones that will actually allow you to have the account in the name of a living trust. So what kind of accounts am I talking about? I'm talking about your checking accounts, your savings accounts, your money market accounts, your certificate of deposits, and any other account that the financial institution may identify that holds cash for your benefit. All of these accounts need to be listed in the name of your trust with those three elements that John spoke about earlier: the name of the trust, the date of the trust, and the identification of the current trustees. I want to focus a little bit on checking accounts. Oftentimes, or at least occasionally, when I talk to a new client, I will find that their checking account is not in the name of the trust. And they rationalize this by saying, well, you know, there's not that much money in the account. My Social Security and my pension is deposit there, but I just have that account to pay my monthly bills. And it will never trigger probate. I hear this all the time when I meet with new clients, and it's probably something they've heard from prior attorneys. One of the things we want to emphasize today is that the checking account, in my book, is one of the most important items that should be in your trust. Every one of you have a trust that is designed not just to avoid probate, but to solve problems that may arise during your lifetime. If you have an emergency, if you have you become incompetent because of a stroke or something of that nature, we all of a sudden have a problem. You were paying your bills from this account. If you're the only one on title to that account, who's going to be able to pay your bills for you during the course of that emergency? If it's in the trust, you all have a co-trustee. If you're married, both spouses are trustees. If you're single, we encourage you, and hopefully most of you have, a co-trustee that serves with you. Now, oftentimes I will have someone say, I already thought of that problem. I've put my son or daughter untitled to my account. To me, that means they have a joint account with their child. It's not something we recommend. By doing that, you have inadvertently exposed yourself to the potential liabilities of your child. Remember, as a joint holder of the account, they're jointly viewed as an owner of that money. If they have an accident, it's their fault, and they get sued and lose, and they don't carry enough insurance to cover the damages or injuries that they have caused, all of a sudden, a creditor could be wanting to take money out of your account, which technically is your account and your child's account, and because they're on there as an owner, the creditor can do that. If you have a co-trustee, the co-trustee is nothing more than a manager. The owner is the trust, remember that. And so the responsibilities and liabilities of your co-trustee cannot affect your assets. In other words, your assets will not stand for their individual debts. So it's much better to make the arrangement for your account to be held in the trust. You'll be able to ensure that you have your bills paid in case of an emergency. You won't have to go to court for like a conservatorship or something of that nature. And you won't be subject to the liabilities of your child. So it's very important that those accounts be held in the name of the trust. For investments, investments too should be in the name of the trust. When I say investments, I'm talking about things that are not held in a retirement account. They are things like stock. They are things like mutual funds. They are things like municipal bonds. Things of that nature. All of these items should be in the trust, and they're held in a lot of different ways, and so that makes it somewhat complicated. You could hold stock certificates yourself. If you have the stock certificates yourself, they're probably in your individual name. They need to be changed. You could hold these accounts as part of a brokerage account. You might have a mutual fund account directly with the mutual fund company, and then you may also have a stock account that is a direct stock account or a dividend reinvestment account that's held and managed by one of the stock transfer agents like Computershare or AST, Wells Fargo Shareholder Services. There's a number of these companies out there. All of these accounts need to be held in the name of the trust. And the way you get them into the trust varies depending upon how you hold that investment. We have your funding instructions. Everybody has funding instructions in your portfolio, and they're a terrific reference tool to let you know exactly how to go about getting these assets in the trust. For example, if you hold a stock certificate, you're going to need to surrender that stock certificate. You're going to need to contact the transfer agent that's listed on that stock certificate to get the necessary forms to do that. What we generally recommend is, rather than you going to all of that trouble, why not just open up a brokerage account? Take the stock certificate to your broker. The broker will add that investment as part of the brokerage account, and the broker can change the account into the name of the trust. In fact, many brokers will actually fill out the paperwork for you, have you come in and sign. Many of these have to be signature guarantee. These are medallion guarantee signatures. The broker can do that for you. If you're trying to do this on your own, it's going to be a little difficult. If you don't have a brokerage account, it's going to be difficult to find someone who's going to be able to provide you with that guarantee. This is not a notary. Usually there's one person at a commercial bank that's able to do this. Oftentimes at credit unions, you'll find that there's nobody there that can do that unless they're actually selling some investments as one of their subsidiaries. If you have a direct account with a mutual fund company, you're going to need to contact them. They're going to send you forms. You're going to go through that same process. If you have accounts with Computershare or Wells Fargo Shareholder Services, AST, one of these companies, again, you're going to need to contact them. The good news is that most of those forms are fairly simple to fill out, but you're still going to need a signature guarantee. So you're going to be needing to search for one of those. You may want to move those to a brokerage account. It's very simple to get the brokerage account in the name of the trust. Savings bonds. U.S. savings bonds, I will often find that savings bonds are one of those neglected items. Oftentimes, people won't put these into the trust because they're afraid that if they have the bonds reissued, which is the term we use, there will be an income tax consequence. Once upon a time, people used to invest in savings bonds because it made them feel good. They were investing in the United States. Nowadays, they're actually a pretty good investment. They pay some much higher rate of interest than you would get at a bank. But they can be a problem. You need to go to Treasury Direct. All bonds are now handled through Treasury Direct. They have a website They actually have forms that you can fill out to have them reissued. You will need to surrender the bonds when you send the forms in. Generally, we recommend that you send them by registered mail. Remember, if you lose a bond, it's like a negotiable instrument. So if you don't have them, you may actually have to get a bond to have them replaced. Treasury Direct now likes to use paperless bonds. There's no income tax consequence. When they reissue the bond, they actually reissue the bond as of the date you originally acquired it. So for example, if you had your bond originally issued in September of 1990, when you get a new bond, if you want a new paper bond, that new paper bond will actually say issued September 1990. And that way all of the interest that has been deferred all of that time does not trigger an income tax liability for you. So if you were afraid to change your bonds because you were afraid it would result in an income tax liability to you, it's not the case. So again, we urge you to have the bonds in the name of the trust.
One more thing I wanted to add to that while you're on that. We often hear people say, but if I add my son or my daughter to my bank account, that means the son or the daughter gets more money than the rest of the children. And they're not going on, as Don said, as an owner, they're going on as a co-trustee. So when they go on as a co-trustee, it doesn't change the distribution schedule at all. The distribution schedule is the same as it was before. You're simply adding another person on as the co-trustee, so as Don said, if there's an emergency, if there's a problem, they have access to the money. One of the popular substitutes for that is called a POD account. Banks love POD accounts. POD stands for payable on death. So if your son or your daughter is the beneficiary on a POD account, and they go into the bank and they say, mother's in the hospital, she's very, very ill, I need the money to pay her bills. The bank won't say this, but basically they'll give you the direction, come back when mom's dead. And you say, I need it now. And they say, no, this is payable on death. This is not payable on disability. This is payable on death. So often when you go to the banks, they will persuade you, I don't know why, to set it up this way. I guess I do know why. So they don't have to look at a copy of your trust. They don't have to go through all the legal mumbo jumbo. So they set it up incorrectly, inconsistent with what we are telling you to do. And then when there's a problem, we can't access the money. So payable on death and I think TOD, transfer on death. Mm-hmm. Don't use either one of those. They're very, very dangerous, particularly when you have a trust that solves the problem. No reason to bypass it and choose another alternative that's inferior. So, and the other thing I want to emphasize that Don said, when you add somebody as a co-trustee, you do not expose yourself to their liabilities. If you add them as a joint tenant, you are exposing yourself. That's not what Don is suggesting. You add them as a co-trustee, and so the liability is not exposed.
Yeah, the other problem with having someone on title as a joint tenant, you're actually giving that person more. By operation of law, when you pass away, the surviving joint tenant now owns that money or whatever's in that account. That might be in conflict with the rest of your estate plan. So if you have a number of children and the idea is to divide the estate equally among your children when you pass away, having a joint tenancy account will destroy the ability to make that equal because this child has now received everything there. It's not in the trust, so it's not subject to the equal distribution that you find in the trust.
Plus, you always have the child who received the extra funds feel guilty and they want to put the money back in the trust. First of all, you can't transfer the money back into the trust. And the second thing is I've never seen a guilty recipient of that money willing to do that, even if they could. So they're actually grateful when we say you can't put it in. They'll say, oh, great, I'll keep it. It's fine. But then the rest of the family is mad at them because they've got all the cash now. And then we got a problem because we can't pay the bills.
Yeah. And depending upon the amount in question, if they say, you know what, I feel guilty about this, as John says, I'd like to make it equal by giving you some of this money, depending on the amount. Now we could be triggering some potential gift tax issues and gift tax returns that have to be filed. So the bottom line is, as you can see, joint tenancy accounts are not a good idea. not a good idea at all.
Well, let's talk about some other assets that typically should go in a trust. And the first one, which most people have this in their estate, is real property. And when we talk about real property, we're talking about, in layman's terms, real estate. That's the legal term for real estate. So it could be your house, it could be your vacation home, it could be a rental property, it could be a timeshare, it could be a piece of land in the middle of nowhere. This is all real property. And by and large, the default rule is your real property should go in your trust. Hands down, should go in your trust, because typically the real property is the one that triggers the probate. There's rules on probate based on value, and we're not talking about real property. But for the most part, real property triggers a probate. So it needs to be in the trust. Now, there are some exceptions to that. First of all, if you have real property outside the United States, most countries don't recognize U.S. trusts. So for those of you that own property outside the United States, it's going to be dealt with in terms of whatever the laws are in that country. Now, anything in the United States should go in your trust. If it's outside of California, that's fine. Your California trust can own that property. The problem is, well, this isn't a problem, but the key to that is, as California attorneys, we can't transfer that property for you into your trust. So if you have real estate that's in another state outside of California, it should still be in your trust, but we can't verify it or transfer it, and you'd have to contact an attorney in that particular state. And that's just a bar rule. That's not us being particular. We just can't do it. For California, though, the property should go in your trust. And the way we do it is with what's called a deed. Now, I'm going to share with you what a deed is, because I thought everyone kind of understood these. But I met with a client a few months ago, and we were talking about his estate, and I said, well, where's your latest deed on your house? And he said, I don't know where the latest one is, but I got something even better. I've got a deed from 1975, the original. And I said, well, I don't know if that's the latest. And he said, no, it's better than the latest. You don't understand. And I said, actually, I do understand. I think we need the latest deed. And so in his mind, he was thinking when he bought the property in 1975, that was the deed to his property. The problem is deeds are kind of like airplane trips. They take you somewhere and then you land. That's where you are at that moment. But then you could get on a plane and go somewhere else. And then that's where you are. So we can't simply say, well, at one point in time, I own the property and here's the deed that proves it, because the deed each time transfers title to somebody else. So you may buy the property and then a few years later you put it in your trust. And then a few years later you refinance it, they make you take it out, and then you put it back in. So there could be several deeds on your property that have been prepared and signed by you. And the one that matters is the last one recorded. That's the one we want to see. And so the reason that's so important is sometimes people will refinance and the institution will say, hey, we're taking your property out of your trust because we can't refinance to a trust. And they take it out, and then you refinance, and then they forget to tell you to put it back in. A lot of the probates, and Don can attest to this, that a lot of the probates are triggered by refinancing. The children come in, or the trustees come in to meet with us, and we say, you know, this property was taken out a few years ago. What happened? And they said, oh, that was when they refinanced, and we forgot to check. So if you've refinanced on your house, or if you've obtained a reverse mortgage, you need to make sure it's still in the trust. And you do that by checking the latest deed. And if in the future you decide to refinance, call our office and we can prepare a deed, taking it out and putting it back in at the same time. We'll record the first one, hang on to the second one until you're done refinancing, and then we record the second one. That way, if something happens in between, we're okay.
I just thought of something I want to share with you. How many of you here ever played the game Monopoly? Okay, the problem with understanding deeds begins with Monopoly. It seriously does. Because when you buy a piece of property, you get a little card that says Park Place on it. If you sell it to somebody else, you negotiate, you take the deed you got and you give it to them. That works in Monopoly. It doesn't work in the real world. In the real world, you keep your original deed, and then another one is prepared with the new person's name on it, and that gets recorded. And like JM said, you got a deed going over here, you got another one going over here, you got another one going over here. And what you may not realize is, when you sit down with us and say, I would like my documents updated and upgraded, one of the first things that our word processors do is they go online, go down to the county where your property is located, and see if we have the latest recorded deed. Even though you have one from 1975, we basically ignore that. We go down to find the latest one. And that might be the latest one, or it may have been refinanced and changed several times. So behind the scenes, we're checking your deeds to make sure that the property you told us in the name, that's in the name of your trust or in your own name, we're verifying that that actually is what the county recorder says. Because what you think doesn't make a difference. It's what the county recorder says has to be recorded.
And by the way, just to clarify, for some of you that have rental properties, you may have created an LLC to protect those properties from liability. If the property is owned by the LLC, the trust owns the LLC, so don't change title on that just because I shared with you it needs to be in your trust. The LLC can still own the property, but the trust owns the LLC. And we'll talk about that in a minute. So that's the same for a partnership or some type of asset protection vehicle you have for rental property. Now, promissory notes are a unique asset because they're not something necessarily tangible that you can see, like a piece of property or money in the bank. Typically, it's just a note. It's a piece of paper that says somebody owes you money. And there's two types of notes that people have. The first one is what we call secured notes. The second one is what we call unsecured notes. Secured means you've got it tied to some asset, usually real property. And so if this person doesn't pay you back, you go in and you can get the property to pay your note back. And for those of you that have mortgages or lines of credit, there's what we call a deed of trust. That's the bank's way of making sure that they've secured their loan to your property. And some of you have loaned money to somebody and secured that note with a deed of trust. So you've recorded a deed of trust that says, I have access to take this property if I don't get paid back. It's very important if you have a deed of trust that the beneficiary is not you as an individual, but your trust. And the reason why that's so important is if you die, they can't pay you back. That can trigger a probate because you're not there to receive the money. It needs to be payable to your trust so your trustee can collect the money and put the money back in the trust. So when we talk about a deed of trust, we want to make sure the beneficiary is your irrevocable trust. And when we talk about unsecured notes, this is a little bit different. This is like you loan money to a child and they basically give you a note and say, I promise to pay you back. But there's nothing secured there. Some of you are laughing. I don't know. Maybe it's really a gift, right? But legally, it's a loan.
Yeah, you think it's a loan, but the
They
child
think
thinks
it's a gift.
Yeah. I wasn't going to go there.
And that is a problem.
Yeah.
That is. By the way, if you don't have it in writing, I would get it in writing. Because some of you think, well, they're good people, they'll pay it back, and I trust them. And you'd be surprised. Things change. And what was once a loan now becomes a gift when you're gone, and now the beneficiaries are trying to figure out what happened. So if you have made a loan and it's not in writing, put it in writing. If you do have one and it's a note that's signed, make sure it's payable back to your trust, not to you. Same problem. If you're gone, we can't give you the money. We need to give it to your trust. Now, for those of you that, just an FYI, you can't make non-interest loans to family members. Is it family members or anybody? Oh, it's family members. Yeah. See, the IRS is smart. They know if you give a non-interest loan, it's a gift. They figured that out. And so they have minimum numbers of interest that you have to charge, and it changes month to month. But it's usually around 2.5% that you have to charge.
Yeah, if you give money to somebody on a loan and you don't charge them interest, that's called stupid. If you make a loan to somebody who's related to you, that's called a gift. Seriously, that's what the IRS says. You're either stupid or it's a gift, one or the other, depending on whether they're related to you or not.
By the way, if you have a non-interest bearing loan that you've made to a child, the IRS is going to impute interest at 8%. So you're
Higher than the required amount.
yeah.
Much
So
higher.
it's important that you charge some minimal amount on there so that the IRS is not imputing interest at what they want you to be paying income tax on.
Now, as a practical matter, when we sit down with our clients and they say, well, I loaned my child X amount of money, and then we say, do they really consider it a loan or is it a gift? And you say, no, they know it's a loan. They're sure. They're positive. And then we say, well, then they'll have no problem signing a piece of paper that verifies that it is in fact a loan. Over 50% of the time, we can't get a signature on that piece of paper. And all of a sudden, mom and dad are going, well, okay, I thought it was a loan, but apparently we miscommunicated on this, not the first time. And so what we'll have to do is go into the trust and make an adjustment to compensate and adjust the distribution for that note. The best way of doing it is have the child sign the note, then the note becomes part of the estate, and then it automatically adjusts and keeps things equal. That's the best way. So you solve the problem by was it a loan, was it a gift, and then you put it back in the estate, and so now it makes an equal distribution.
And that's really important because I get a lot of requests from clients that say, I've made loans to my children. They have these promissory notes. I want to put that in the trust and make sure it's deducted from their share. If you do that, you're now deducting their share and they owe the money back. So it's kind of a double hit. So if you have a signed note, it doesn't need to go in the trust, in the distribution. That's just part of one of the trust assets. It's this note out there. The only time we put it in the trust, like John said, is if they don't sign a note, nobody knows about it, then we can reduce their share accordingly so that it gets paid back when you pass away.
By the way, I hate to be basic on this, but this is very important because it caused lots of family arguments. It's not just the value of the note, it's what everybody thought and didn't think and understood and misunderstood. So it's important to have it signed. Now, you're going to think this is silly, but the person who owes you the money needs to sign the note, not you. I've had clients who have said, well, if they won't sign it, I will. Well, okay, so you're obligating yourself to pay back? Well, no, but everybody understands what I mean. You got to get the person to sign it. They have to acknowledge that it is an IOU.
All right, let's talk about business interests. And this is a much deeper topic than we have time to go into all the details on tonight. But I want to give you an overview of what happens with business interests. First of all, when I say business interests, I mean LLCs, corporation, a closely held corporation, not your stock in Apple or whatever, but a family business that you own stock in, a partnership, or in some cases just a sole proprietorship. LLCs and general partnerships are done relatively the same. You're either a general partner, you're a limited partner, or with an LLC, you are a member. Regardless of which one it is, your interest in that partnership or that LLC gets assigned to your trust. And it's a simple document that says, I'm assigning what I own in this partnership, because you may have a small percentage or a large percentage. Whatever you have, you're putting into your trust. That way, if you pass away and there's value to this partnership, it could be real estate, it could be a business, your trustee has the ability to come in and either liquidate your share or transfer it to the beneficiary so they can continue enjoying the benefits of that. If it's an LLC, it's done the same way, but now you're a member and you assign your interest into the trust.
Oftentimes, if there are many members of an LLC, you will actually have certificates. They almost look like stock certificates. And in that instance, we need to actually issue a new membership certificate to you as trustee of your trust, as opposed to just doing the assignment. If someone doesn't have a membership certificate, then we do as JM says, we will actually do an assignment for you.
Yeah, that's a good point. And the other point is, too, when we do assignments, sometimes you have partnership agreements that require the other partners to sign off on a transfer. Now, we don't necessarily want to do that or get their signature, but we have to, because that's the agreement. So here's the important part. If you get an assignment and it's got 10 different partners that have to sign off on it, I always get calls. I get a client say, I don't know who half these guys are, and I need to get their signature. You do because your partnership agreement requires it. And it's different every time because some agreements say that you can transfer it to whoever you want. Some say they need to have the consent of the other partners. The corporation that you have is a family business or some closely held stock. Typically, there is some type of stock certificate that's been issued. And if you set up a corporation, they give you what's called a corporate kit. And in that kit, there's blank stock certificates that you issue to everybody who holds the stock. On the back, typically, there's some type of instructions, or in the kit, there's instructions on how to reissue the stock. And that's typically what you do on closely held corporations. You reissue the stock in the name of your trust. And then you now own it as trustee and not as an individual. The last one, real quick, is sole proprietorships. This just means you own a business that's in your own name. Typically, they're small businesses that you do on the side. There's not a lot of employees or whatever. It's in your name alone. There's nothing legally that you're transferring other than your ownership to the trust. And so we prepare a bill of sale. The bill of sale says you're giving your interest that you own in this sole proprietorship business to your trust. And sometimes some people will have a DBA or a fictitious name they're doing business under. You have to record that with the county recorder and let them know that you're doing business as a trust, because there's a separate name that gets recorded under the county records. Real quick, it's not up here, but I'll mention this for those of you that are wondering about personal property. It doesn't need to go in your trust. That's the general rule. So furnishings, cars, jewelry, china. By the way, when I say cars, I mean the regular car that's worth an average amount. If you have a Lamborghini, it should go in your trust, okay? I know most of us here don't have that problem, but for those of you that do, don't leave that outside your trust because it will trigger a probate. They basically say whatever you have outside your trust gets added up, and as long as it doesn't exceed $150,000, we're okay. Most people don't get close to that, but when you add in a Lamborghini or a very expensive boat or something, an RV is common, a big RV, those types of things will get you real close to the limit, and then we have a problem. So to be safe, put those in the trust. But for the most part, everything else can stay outside. And if you want to give that, just as a side note, if you want specific people to get those items, like you want your jewelry to go to your daughter or your painting to go to your son or whatever, you list it on a memorandum. It's a simple document that says, here's the item, here's the beneficiary, and then the trustee can distribute those items.
So the practical way you do that is you tell us what you want to go to whom, if you want to be very specific, and then we prepare the memorandum for you. So you just give us the information, we'll prepare the memorandum.
And we don't need to know every single thing. We don't want to know where the towels go. We don't want to know where the,
Now you laugh, but we do get those requests periodically.
We occasionally will get like a 15-page long list of things that say, the towels in the linen closet in the hallway of this. And it's like, are you kidding me?
Yeah, your beneficiaries don't care. The coasters can go to whoever they want. They'll figure it out. So that's personal property, and I think, let's move on to non-trust assets. John?
Okay. Just a side note here. We're sharing with you some information, and just as sure as we're sharing it with you, you're going to have somebody else tell you something a little bit different. So, no disrespect to banks, but if you have a banker who just started last week, graduated from high school 2 months ago, and they're giving you some advice, be very, very careful. Let me give you an example just so you can solidify this. I was at the gym 2 weeks ago, and I was in the dressing room changing, and a cell phone went on. And it was ringing, and everybody's looking around like, is somebody going to answer that cell phone? Finally, a guy walks over, pushes the button, and puts it on speaker. It's kind of weird. So he puts it on speaker, and you hear a voice say, honey, are you at the gym? And this guy says, yes. And she says, oh, did you have a nice workout? He says, yes. She says, I hope you're in a good mood. He says, why? Well, I'm at Nordstrom's and I found a dress that I really, really like, and I'm just wondering, are you okay? And he says, well, yeah, I'm okay. Why? She says, well, it's going to cost $1,000. And he says, well, that's not a problem. Do you really like it? And she says, I love it. He said, why don't you get 2? Then if it wears out, you have another one. There was a long pause. Everybody in the gym is just going, whoa. And he says, yeah, get 2 of them. She says, okay. He says, anything else? She says, well, as long as you're in a good mood. Are we going to buy that car? And he says, what car? She says, don't play with me. You know the one that we saw at the Lexus dealership, the display model? He says, oh, yeah, I think we ought to get that. There's a long pause. She says, get it today? And he goes, yeah, go down and pick it up and put all the options on it. Long pause. She says, okay. So now you're in a good mood. How about that second piece of property that we're going to buy? The one right on the beach? He goes, I think we ought to get it. She goes, wow, you are in a good mood. He says, I am in a good mood. Anything else? She goes, no, that's it. Thanks, sweetheart. He hangs up, holds up the cell phone and says, does anybody know whose cell phone this is? When you're asking questions, make sure the person that's giving you answers is authorized to give you those answers. Now, I hate to see what happened to the guy who owned that cell phone. He was in for a big surprise. So, again, when you say, well, my barber told me, and he cuts the hair of a law student, and he said, I mean, we just patiently listen to all this and we say, okay, are you done? Now we'll tell you how to do it. But the guy down at the brokerage firm says, okay, let us tell you. We're not going to tell you how to invest your stuff, but we are going to tell you how to hold title to get the items inside the trust and have them coordinate with your estate plan. Now, the next section is what you do not put in the trust. And this is very important because if you go to your broker tomorrow morning, your investment advisor, and you say, I went to this program last night and they said, put every single thing in the name of the trust. We did not say that. If you put your retirement account in the name of the trust, you will get a letter from the IRS that says, looks like you made an early withdrawal. You say, no, I didn't. I just put it in the name of the trust. That is considered an early withdrawal. And it's irreversible. So be very careful. IRAs, KEOs, 401ks, TSAs, those do not go in the name of the trust. They have special tax-deferred language in there. So what do you do with the retirement account? How do you deal with it? Well, what you want to do is name a beneficiary. If you are married, the best beneficiary of your retirement account is going to be your spouse. Now, when I say retirement account, I'm not talking about the money that you've saved up that you're hoping to use someday when you retire or someday when you want to go on this big trip. I'm not talking about the money that you call retirement. I'm talking about the qualified plan that the IRS says is a retirement account. So the first thing that you do if you're married is you name your spouse as the primary beneficiary. Now, when the assets transfer from a deceased owner of an IRA or a 401k, and it goes to the surviving spouse, that process is called a rollover. When the assets are transferred from the surviving spouse down to the children, that is not called a rollover. And you can get in all sorts of trouble if you teach your children to roll over the account. They cannot do it. A rollover is only available for a surviving spouse. The rules are very different for the recipient of a rollover account than they are for everybody else. And the only person that can roll it over is the surviving spouse. When the first spouse passes away, they have certain rules about the account. In other words, how soon can you take it out? How soon must you take it out? One is an option, one is a requirement, and they're both based on age. And if you die and there's still money in the account, the surviving spouse, who now rolls the account over, now those rules regarding when you can take it out and when you have to take it out now apply to the surviving spouse. Now, the surviving spouse has a couple of other options, but that's usually the one that they utilize, is the rollover. Then the surviving spouse will name somebody else as the next beneficiary. Often it's children. Be very careful. If you are a spouse with children from a previous marriage, and you marry somebody with children from a previous marriage, and you have a lot of money in your retirement account, when you die and you name your spouse as the beneficiary, it might not be coming back to your children. Now you say, oh yes, I did that on my retirement account. I named my spouse first, I named my kids second. When the surviving spouse survives, second is 0. It goes away. This now belongs to the new spouse, the rollover spouse, so to speak, and then this spouse chooses his or her own beneficiaries. So be aware that when you name the beneficiaries, you get the first crack. The person who receives it gets the second option. Okay? Now, the second thing to be aware of is when you name a son or a daughter as a beneficiary, or a grandchild, or a niece, or a nephew, or anybody, they don't have the rollover option. They have what is called the stretch option. What that means is they can either go into the custodian that's holding the money and they can say, I'm the beneficiary, give me all the money today. Now you know what the problem is on that. All the taxes are due immediately, unless it's a Roth, in which case there wouldn't be taxes. But most of them would be a traditional, and so they would have to pay the taxes. That's one option. They shouldn't take it. By the way, this is extremely important. If your son or your daughter goes into the bank and the person that's helping them started last week, and they're going to say, I'm the beneficiary, so what should I do? Well, I don't know. Let's just cut you a check. So they cut them a check, and then the person that receives the check goes down to their broker to invest it, and the broker says, oh my gosh, where did you get that money? Well, my mom and dad passed away. It's out of the IRA. And the financial advisor goes, oh, please don't tell me you did this. And the child's reaction is, no problem. I can just go back to the bank and give it back to them. No, you can't. Once it's out, it's out. And that's very confusing because if you have your own IRA and you want to move it from one account to another account, you have a certain period of time to do that. When your parents pass away and you pull the money out, you don't have a certain period of time to do anything. It's all over. It's done. So what they should do, what the son or the daughter should do is they say, I want to stretch the IRA. I want to stretch the 401k. I want to stretch it over my lifetime. And what that means in English is the IRS, in their infinite wisdom, has decided how long all of us are going to live. They have a life expectancy table. And so they say, if you were born on this date, this is how long you are expected to live. And there's a table that tells you that. And so you go to the custodian and you say, according to the table, this is how long I'm going to live. So take that number, divide it into my share of the IRA, and give me a check every single year. You can get more money if you want, but you can't get less. The IRS says it's got to come out. Now, obviously, the younger the beneficiary, the longer the stretch. Now, there's a little bit of a problem. If you go too young, you may go below the age of 18. We've had a number of clients who have named grandchildren as beneficiaries of their IRA, and the grandchildren are 2 and 3 years of age. Picture in your mind a 4-year-old going into Charles Schwab and saying, hi, my life expectancy is about 80. I'd like a check every month. Don't give it to my parents because they'll waste it. Send it directly to me. You can't do that. Even if you're 17 years of age, you walk in. They won't let you do that. You have to be 18 years of age. So naming a minor is a good idea when it comes to the stretch, but you can't name them directly. You have to use another vehicle, which is called a retirement trust. Now, briefly, the retirement trust becomes the recipient of the IRA, and the trustee of the retirement trust is very often the parent of the grandchild. So now they're going to the custodian and they're saying, this IRA is payable to this retirement trust, but the retirement trust is payable to my 3-year-old. So take their life expectancy, divide it into the number that is going to be allocated to them, and send me a check as their trustee until they reach a certain age, and then they become their own trustee of the account. So a retirement trust is often used to be the recipient of funds when you have a very, very young recipient beneficiary. Is it ever used for children? Yes. Let's say that I pass away and one of my children goes into the custodian and says, "Hi, I'm one of 5 children from Mr. Preston, and he died and mom died, and my life expectancy is thus, and I want to receive a check every single year." They did it right, thank heavens. They're stretching the IRA. Good job. Mom and me are looking from up ahead, down below, and saying, "That's great." I know some of you saying, well, one of you might be looking up instead of down. I know who you're talking about, okay? It won't be my wife. So we're looking down, we're saying, this is really good, this is really wonderful. They stretched it exactly the way they were supposed to. Now here's the problem. This child that I'm referring to is driving down the street. They get in a horrible automobile accident. They get sued, they lose the lawsuit, there's a judgment against them, and the creditor goes to the custodian and says, "I have a judgment against this person. Do you have a distribution being made payable to them?" And they say, "Yes, we do." And they say, "Thank you, I'll take all that money." Now, that's bad. They lost all their money, it gets worse. The IRS sends them a letter and say, "We see you withdrew all of your money." And the recipient child says, "I didn't withdraw anything." And they say, "Oh, correction, your creditor did. You still owe the money." So what's worse than losing your inheritance? Losing your inheritance and then paying the tax on money you never saw. So if you have an adult child, it might be wise to have that IRA payable directly to the retirement trust, and then the retirement trust is payable to the child. So now when the child gets sued and they go to the custodian and they say, "We want the money for this child," the custodian says, "I'm really sorry, this account is not payable to this person, it's payable to that trust." And the creditor says, "Well, who's the trustee of the trust?" "Well, that happens to be Mr. Preston's son." "Well, he's the one we have the judgment against. We'll go talk to him." So they go talk to the son and they say, "We understand you're the trustee of this trust." "Yes, I am." "Well, we have a judgment against you." "Well, let me read the terms of the trust and see if I can pay you." They read the terms of the trust. It says, "Can't pay creditors." They turn around and show it right there. "I can't pay. I'd love to. I feel bad. But it tells me right there I can't do that. I'm a trustee. I'm a fiduciary. I have to follow the rules." Now, I have to tell you a funny story. I'm meeting with a lady yesterday, and she says, "I don't know that I want to have a retirement trust." And I said, "Well, you don't have to do that." And she says, "I only have $200,000 in the account." And I said, "Okay." And she said, "So when I die, I'm just going to name my daughter as the beneficiary." And I said, "You can do that." And she said, "Do you think I need a retirement trust?" And I said, "It's entirely up to you. But let me put this in perspective. You use the word only and 200,000 in the same sentence. I never do that." She says, "What do you mean?" I said, "Well, when you pass away, if your daughter comes in and says, 'Well, I'm here to get the estate that my mom left. It was only $200,000. And I say, "I agree with you. It was only $200,000. I gave it to my grandkids. It wasn't that much." Now, do you think the recipient child would say, "Okay, I agree with you"? No, $200,000 is $200,000. Now, I will leave it up to you as to whether you think the retirement trust is appropriate, but if you're going to name a minor, you got to use it. You don't have a choice. If you're going to protect your children's inheritance from lawsuits, creditors, divorce, bankruptcy, a retirement trust will do it. Otherwise, they're exposed. And again, they're not just exposed in losing the asset, they're exposed in losing the asset and then paying for the money they never received. So those are the assets that you want to keep out of the name of the trust, the retirement accounts, and then we use a retirement trust as a recipient beneficiary.
And by the way, that retirement trust, don't confuse that with the trust that you all have.
True.
Retirement trust is a separate, specially crafted trust that meets the IRS regulations to qualify as a beneficiary under your retirement account.
That's a very good point. Don't call your financial advisor tomorrow morning and have them make your revocable trust the beneficiary of your IRA. Do not do that. That's extremely dangerous. Very good point. It's a special type of trust for the sole purpose of being the recipient of an IRA or a 401k or a KEO, a retirement account.
Okay, I'm going to talk next about annuities. And if that didn't seem complicated, what John was talking about a minute ago, this is going to get more complicated, and I apologize in advance. You'll notice in your funding instructions, we devote 3 pages of your 15-page funding instructions to summarize the rules for retirement accounts. For annuities. Annuities present a registration dilemma. Let's just put it that way. There are a couple of reasons why you can't make generalized rules about annuities. The first is that they're contracts, and they're all different. So your annuity is actually governed by the terms in that contract itself. And what compounds that is the fact that the insurance industry is constantly coming out with new products for annuities. And I'm going to talk about a couple of the latest types of annuities that are out there that make it very difficult to generalize about what you want to do. When we talk about annuities, first of all, please remember that we've got 3 elements to an annuity. There's the owner. The owner of your annuity is the person that has the right to exercise the exercise the rights under the annuity contract. In other words, this is the person who can name beneficiaries. This is the person who can make withdrawals. This is the person who can annuitize the annuity if they want to. The second person is the annuitant. The annuitant is the measuring life of the annuity. Think of it like the insured under a life insurance policy. It's when we determine the benefits can actually be paid out under the annuity. And then finally, we have the beneficiary, and of course the beneficiary is the recipient of the annuity proceeds when the annuitant passes away. So what I'm going to describe tonight is the kind of general recommendations. You notice I didn't say this is what you need to do. There are general recommendations that we will have for annuities. And the type of annuities I'm talking about are annuities that are not part of a qualified retirement plan. In other words, this is not an annuity that you have in your IRA. It's not an annuity that is part of a 401k or something of that nature. This is an annuity that you hold outside, typically in your own name.
So let me emphasize what you just said. That's extremely important. If you have an annuity inside of an IRA, you follow the IRA rules. Ignore everything he's going to tell you. If the annuity is inside the IRA, you follow the IRA rules. If it's outside the IRA, you now follow the rules that he's going to share with you. This is why it's so complicated.
Exactly. I was going to say this is why this area is very complicated. One of the things that we tell people is that when it comes to annuities, it's really important that you consult with the financial advisor that sold you the annuity, because that financial advisor is going to know what the terms of that particular contract provide and whether or not it's a good thing or not a good thing to do.
Or should know.
Or should do.
Should know.
Yeah, should know. Should know. So let's start with the owner first. As a general rule, we don't recommend that you transfer ownership of your annuity into your revocable living trust for a couple of reasons. Number one, annuities generally defer all of the growth. So as that annuity continues to grow, you're not paying tax on an annual basis on that annuity unless you're pulling out withdrawals. We always are concerned that the insurance company, if you transfer it from your individual name to your trust, will consider that a taxable event that triggers a tax for you on all of that growth. In other words, they may send you a 1099 at the end of the year in which you've made that change. They're not supposed to do that, but it may happen. And if that happens, you don't want to go back and try to explain to the annuity company that they shouldn't have done that. The IRS has already received the 1099, and so they're going to be expecting you to pay tax on all of that growth. One of the reasons you have this annuity is to be able to build up wealth over a period of time that is tax deferred. So that's one reason why it is a little scary to transfer your annuity from your individual name into your trust name. The other problem that we have seen in many cases that if you transfer your trust from your if you transfer your annuity from the ownership from your individual name into the trust, you may actually inadvertently limit some of the lifetime benefits under your annuity contract. And we certainly don't want to do that. So again, that's an important reason to talk to the financial advisor that sold you that annuity, because they should be able to tell you whether or not any transfer like that could put in peril some of the lifetime benefits you have under that contract. So let me just clarify one thing. If you already have the owner of your annuity as the trust, I'm not telling you you should now change it into your individual name, because we could have the same problem if we switch back to your individual name that we had when we were trying to transfer it in to begin with in terms of income tax consequences. So if you've acquired it initially in the name of the trust, hopefully your financial advisor said, that's okay, you're not going to sacrifice any special benefits under the policy if you do that. And if it's done that way, leave it that way. If it's in your individual name, generally we tell you it's a good practice not to change it, at least without making absolutely sure with your financial advisor that there won't be any adverse effects from doing that. Okay? The annuitant. This one's the easy one. The annuitant can never be your trust. It has to be a person. It has to, like I said before, it's a measuring life. Your trust doesn't die, so it would be very difficult to figure out when the proceeds would be available to the beneficiaries, wouldn't it? So it's going to be an individual. Typically, the annuitant and the owner are going to be the same person. Or at least if it's a joint owner, one of the joint owners is going to be the annuitant as well. What we don't like to see is an annuitant being one person and the owner being a different person. And I understand why it's done. I'm not going to go into it now. But here's the potential consequences of having that. If the owner dies and not the annuitant, is the annuity going to pay off? No, because the annuitant is still alive. The measuring life is still alive. But now we have a contract that doesn't have an owner. And the next thing you know, nobody can change the beneficiary designation. No one can exercise the rights under the annuity contract. And in fact, many life insurance companies, when they find out the owner has passed away, they'll say, we need a new owner. And if your annuity contract happens to be more than $150,000, guess how we get a new owner? We go to probate. I have done several probates where the wrong person died first. And the sad part about this, are those probates free? No. The court doesn't say, yeah, we know you're not going to get any money from the annuity, so we're going to waive all of our costs. You think the county will do that? No. So you're going to have the expense of a probate, but not the money inside the probate to pay the costs. So that's a problem. So typically we like to see the annuitant and the owner be the same person. So far, so good. Now we get to the complicated part. The beneficiary. This is really difficult to generalize, but there are a couple of rules that we can talk about. If you have a trust that doesn't continue on after you pass away, If you're married, it doesn't continue on after the surviving spouse passes away. If you're single, it doesn't continue on. In other words, it's an outright distribution to some named beneficiaries. In that case, we recommend that if you're married, name your spouse first, and then the children, especially if, unless you don't like your children. If you are not married, name your children, or if you don't have children, name an individual beneficiary or beneficiaries. It doesn't make a lot of sense to name your trust as the beneficiary under those circumstances, only to have the annuity put into the annuity proceeds to be put into the trust, only to take them right out again because it's an outright distribution. So simply have it distributed that way. Many of you, however, have trusts, many of you have trusts that don't terminate when you pass away. They continue on. Many for the benefit of the children for asset protection purposes, some even going down to the grandchildren so that there can be an estate tax-free distribution down to the grandchildren. Under those circumstances, we now have a dilemma as to who we should name as the beneficiary. You can still name, if you're married, you can still name the spouse as the primary beneficiary. The contingent at that point in time could be either the children directly or it could be your trust. And here are the reasons why you might want to do one or the other. If you want the asset protection of the proceeds from the annuity, you might want to choose the trust as the beneficiary at that point in time, so that the annuity proceeds can flow into the trust and into the separate trust shares for the children to give them some asset protection. If it's going to go down to the grandchildren, ultimately that money might end up going down to the grandchildren. Here's the consequence of that. If you have a lot of deferred income inside that annuity and it's paid out directly to the trust when you pass away, do you think there's going to be some tax on that money? Absolutely. Who's going to be taxed? The trust. So that's going to trigger an immediate income tax to the trust. Now, the trust, many of you may have known this if you've listened to some of our programs in the past, the trust pays a higher rate of income tax than you do. Yeah, isn't that interesting? If a trust retains $11,900 worth of income in a calendar year, that trust is already paying tax at the 40% bracket. You would have to earn either $400,000 or $450,000 before you would be in that same similar bracket. So obviously the trust is going to pay a lot of tax on those annuity proceeds, and you're going to lose quite a bit of that money. It will be protected, but only the net proceeds after the tax are going to really be protected, aren't they? So some of our clients will say, I like the idea of the protection, I don't like the idea of the income tax. How can I avoid some of the income tax? Well, you can name the individual children as the beneficiaries directly if you are not married, or as the contingent beneficiary if you are married. And if the proceeds go down to the children, they may have some benefits under the contract to stretch out the withdrawals over a period of like 3 or 5 years. That way they can stretch out the income tax consequences. They're also perhaps paying income tax in something less than the 40% bracket, so they'll be able to keep much of that. Here's the problem, though. Will those assets be protected now that they're in the individual's names? They won't be, will they? You now own them, so they are now vulnerable to your creditors. So you can understand now why it's very difficult to say, this is the rule, this is what you should do. It's really going to be a choice depending upon the type of trust you have and the goals that you want to achieve. Okay?
And by the way, a lot of you passed out when he told you about that tax rate for trusts. That doesn't apply to a trust you have created. I saw 2 people just leave to go file their income taxes, so I needed to clarify that. It doesn't apply to a revocable trust which you create. It applies to the trust after you pass away because the rules on the income tax change. And you can avoid that by pulling the income out, or your children can pull the income out. The problem is when the money goes directly in, then it triggers that tax.
And again, remember, if they pull the money out, they've lost the asset protection, haven't they? So if the goal is to achieve the asset protection, there's going to be some sacrifice by retaining that income in there and paying tax at a higher rate. The good news is it's not going to be your choice. The bad news is it's your hard-earned money that may end up going to Uncle Sam. So it's a choice. I want to mention something about a couple of new products that are out there. Nationwide has a new product out there. Genworth has this product too. They have joint owners, and believe it or not, the owners are also the beneficiaries. Now think about that for a second. Okay? If you own something, if you own a life insurance policy, does it make any sense to name yourself as the beneficiary? Not likely you're going to benefit from that. However, Nationwide actually has an annuity contract where if it's owned by either spouse, both spouses are named as the beneficiary.
And it doesn't trigger probate when one of those spouses dies, even though they're beneficiary. It's a very, very unique product.
And it comes, regardless of who passes away first, there's a life insurance benefit that accrues to the survivor of them, which is kind of interesting. Now, if you change that ownership to the trust, or you change the beneficiary to the trust, all of a sudden now you have ruined that special benefit that you're getting under this annuity contract. So if you have one of these new Nationwide annuities, you've got to be very careful how you're arranging your ownership and your beneficiaries. Now, Genworth used to sell this product as well. I understand that Genworth is not selling it anymore, but the Nationwide product is fairly popular because it's a new product in the industry. And this just goes back to what I was saying at the beginning. It's difficult to generalize about what to do with these contracts when the industry continues to come out with new revolutionary products. So again, the best thing you can do is consult with the person who sold you the annuity, and we can talk to them about our concerns, especially if they're a little unsure. But to be honest with you, the best person who's going to know about the terms of that contract is the person who sold it to you, not us. Okay?
And by the way, we can assist, as Don suggested, but only if we know that you have the particular annuity. In other words, if you give us the information, our staff is on alert if they see Genworth or Nationwide. They're on alert that you have to have the dual beneficiaries there. It's the only annuity that has that on it. If it's another annuity, then there are some other rules that follow. But when Don says be very careful, basically what that means is tell us what you have. We can give you the warnings, we can give you the options, and then let you make an intelligent decision as to which way you want to go. But we can't help you if we don't know what you have.
So that's all as clear as mud, right? Okay. Yeah, I apologize. It is a complicated area. Like I said, we devote 3 pages of your 15-page funding instructions just to summarize this thing. So it is a very complicated issue. People write entire books on this subject.
And the reason why this is so important is because annuities are very popular. There are some features with annuities that are very attractive. And so the popularity is increasing, and the amount that people are putting in annuities are increasing too. So we just want to make you aware that you have to be very careful how you own it and who the beneficiary is and double beneficiaries and that type of thing.
Yeah, once banks virtually stopped paying interest on accounts, annuities became much more popular than they ever were. And that's why the industry is constantly sending out new types of products.
And when Don says they write books about this, he's not kidding. There are books and books and books about annuities and how they work and how they're attractive and how you set them up, and it's a very complicated area.
So I think now JM is going to talk a little bit about life insurance policies.
For those of you that were hoping that we would keep talking all night about this exciting subject, the bad news is we're almost done. For the rest of you that have smoke coming out your ears, and I can see some of you out there, we're just about done. The life insurance is the last asset we want to talk about. And this one's really important because a lot of people have life insurance. And typically, there's two recommendations we give depending on the size of your estate. If you have a taxable estate, meaning your estate is going to exceed the federal estate tax exemption, if you are getting close to that level or you're exceeding it, we recommend you get the life insurance out of your estate. Now, the reason why we focus on life insurance is because it's one of those assets you can transfer out of your estate and not incur a lot of gift tax problems. And the reason why is when you transfer it out of your estate, you're not really transferring the full value of the life insurance. You're transferring what it's currently worth today, which is usually not what it's worth when you die. So it's one of those unique assets that gives us the opportunity to pull things out, get it out of the estate. Then when you die, it's not there. It's not included in your taxable estate. Now, for the rest of us that don't get near that amount and we're comfortably below the exemption, we have a different recommendation. We recommend that the beneficiary and the owner should be your trust. Now, this surprises a lot of people, and there's two reasons we recommend this. Number one, if you're married and the first spouse passes away, we can use those assets when we divide the estate. They can be put in the decedent's side of the estate for asset protection purposes. If it's payable directly to the spouse, that option's gone. So if you're married, it helps with the division. Now, when it goes down to the beneficiaries, some trusts, like Don shared, continue on to give them asset protection. If you don't name the trust, the money will never be in there to be protected. It goes directly to the beneficiaries. And once they get it, they can't say, I'm going to put it into my nice asset protection trust. It doesn't work that way. It has to come directly from the insurance proceeds. So there's two recommendations. If your estate is getting close to the taxable amount, the recommendation is to get it out of the estate. And the way we do that is what's called a life insurance trust. We won't go into that tonight, but that's the way we get it out. For the rest of us that have the estate well below that amount, we make the trust the owner and the beneficiary. And that's really all there is with the life insurance. John?
That's pretty simple. So let's go back to annuities, because that was a popular topic we want to discuss. So where do we go from here? What do? You should have two thoughts at this point. The first thought is, there is a possibility that I didn't catch everything that these guys said tonight, and I may have missed something, which first of all is the reason why it's being videotaped. Okay? And the good news about the videotape is you can stop it, pause, take a breath, write it down, maybe go get a drink and relax, and then come back and start that thing again. Get the courage to do that. That's one option. The second option is what we call the verification process. Now, let me explain this. The verification process means when your trust was initially created, we basically created a bucket that did all sorts of wonderful things. And what we heard from you is, I have my assets in the name of the trust. You restated that document, or you amended that document, and now my assets that were controlled by the previous trust are controlled by the new trust. That's what you say. But then we say, may we see your assets? Can we look at the assets to see if they refer to your trust? And so we send you a questionnaire. And sometimes you get this questionnaire and you say, I already filled that out. I don't need to fill that out. Well, the questionnaire that you filled out says, do you have a bank account or accounts, and how much? That's all it says. The new questionnaire says, tell us exactly how many bank accounts you have. Send us a copy of the statement so that we can review the statement and see who the registered owner is. That's the bank accounts. Then we go to the brokerage accounts. Then we go to the stocks. We go through all these items. We say, basically, send us what you have, and let's verify that everything is registered correctly. That is called the initial verification process. Then there's the annual verification. The annual verification is in your package that you receive that goes out of our office on January 2nd every year. And that verification package, or the annual verification package, is saying, what has changed? Now, if your bank account has changed by a couple of bucks, that's not a problem. If your bank merged with another bank and the new bank didn't get the registration correctly, and I won't name any names because we're being taped, but there were some major mergers recently, and when the dust settled, your assets were not in the name of the trust. It was just one of those details that they didn't quite take care of. And so you look at the statement, and now the statement says something different than your living trust. So on the annual verification, we basically say, tell us what's changed. We don't mean the bank account went up or down. What we're asking you is, did the bank merge? Did you cancel that account and move it to another account? Did you move from here to over there? Now, when you tell us that you moved your account from one place to another, and we say, well, we need to verify it, and you say, I already have. We say, how did you verify it? I just looked at the statement and it looked good to me. On your statement, it will say, not verified. And you say, well, don't you believe me? And the answer is no, we don't. Because we can't say we verified it. We heard you say you verified it, but we're doing it for you. It's part of the whole process. It's not like there's an extra charge to do this. We do it. But when you get that sheet and it says not verified, that means our eyes have not seen your statement. We believe you, but we still want to see the statement. Beneficiary designations, life insurance owners, annuities, all these things. We're going through every single item. So let me recap this real quickly because there's a little bit of confusion here. There's the initial verification, making sure everything is registered in the bucket that should be, making sure that those things that are not supposed to be in the name of the bucket have a beneficiary designation correctly. That's the initial one. The annual one is to see if there are any changes. Sometimes, bless your heart, sometimes you will send in the statement in January and say, the thing I got from January is changed. And so we look at it and you say, when are you going to send me an update? Next year, it's an annual update. Well, I need it today. Why do you need it today? I want to make sure I'm verified. Okay, we verified. March, you send another statement. The bank account changed again. I don't know how it happened. Update my sheet. We don't do this every month. It's called an annual verification. And then we get another statement that says, I think my bank account's changed again. I don't know how it keeps happening, okay? So we don't do this on a monthly or weekly basis. We do the initial one, and then we do it annually. Now, does that mean that if you buy a piece of real estate in the middle of the summer, you can't call us? No, it doesn't mean that at all. Pick up the phone and call us and say, I'm buying a piece of real estate. Is there anything I should know? Well, do you want us to talk to escrow, or do you want to just read your instructions, or shall I tell you how you should hold title? Because we'll tell you the name of the trust, the date, and who the trustees are. And you say, oh, that's great. I can tell escrow that. Well, that's fine. When escrow closes, mail us a copy of the deed so we can verify it. Okay? And if you say, well, I verified it, we haven't verified it, so it doesn't work that way. We got to see it to verify it. And all we're doing is we're just trying to be extra, extra careful to make sure that we don't have any surprises when there's a death that occurs. Now, if you have any questions about anything that we have shared with you tonight, first of all, you're more than welcome to call our office. If something is really disturbing you, you're more than welcome to call. Personally, if I were you, unless something is earth-shattering, I'd wait to get the DVD and watch it. If you have questions, you're more than welcome to call at that time too. I would also suggest that you share the DVD with your children. Some of them have trusts and they're not clients of ours, and they're going to have surprises when they die and find out that the assets are not in the name of the trust. Because it is not typical for an attorney to verify your assets. That is not typical. It is also not typical for an attorney to spend an hour and a half with all these clients on a DVD and putting this in video form to explain this detail. That is not typical. So if you have children who have trusts and they would like to verify whether their assets are in the name of the trust, you might want to share with them the DVD. Thank you very much for coming. Please drive home carefully. See you again.